bienvenue ce matin. Merci de vous être levé tôt pour venir à cet atelier. So we are very happy to have you today to discuss about this specific session dedicated to USA. We've got a lot of information to share with you, with also the panel sitting here and also connected. So I'm going to present the whole team, but of course we hope that you will find what you are expecting, and do not hesitate to raise your hands if you have some questions, and there will be a specific Q&A session. The session will be recorded. So I'm very happy as a moderator to have very knowledgeable people with us today. So I'm going to present shortly myself. So Cyril Lelarge, I'm leading the insurance for Sanofi Group. I'm dealing with P&C risk, and also I'm involved in the employee benefits, also underwriting and management. And I'm quite often dealing with US exposure on the day-to-day, not only because we are listed in the US, but we've got a significant type of exposure. And today I've got the chance, and this is how I would say the speakers were chosen, to have a very, I would say, leading insurance representative, the P&C market, particularly on property damage and casualty. So this is why we've got today Tina from Chubb. So maybe you want to say a few words, Tina?
Sure. Thank you, Cyril. So good morning, everyone, and hello. I'm Tina Lakikis. I'm head of broker and client engagement for Chubb Overseas General. I'm currently living and working in London. I just moved to London a couple months ago, so I'm new to London and I'm new to this role. Prior to living in London and working in London, I spent 5 years in Paris, and I was leading our major accounts division for Chubb Overseas General, which incorporates our international organization. So it's all countries, regions, and territories outside of North America. And then before that, I spent my entire personal and professional life in the States, Chicago, Illinois. I don't know if you are familiar with it, but spent a lot of time there. I grew up with a casualty underwriting background, dealing primarily with large multinational corporations like yourselves. And I am absolutely just delighted to be back in France. So thank you very much for inviting me and for having me today on the panel.
Thank you, Tina. So on the insurance side also, we've got Loïc Ledréau that is connected from his home, because unfortunately, Loïc, when he was coming back from the US last week, learned that he was positive on the COVID. So a few words of introduction. Loïc, I don't know if people in the meeting room can see you with the technique.
I don't know if you can see me, but I can hear you. Can you hear me?
Yes. Yes, okay, we can.
10-4.
So it will be hello. My name is Hello, and hello to everyone. So Loïc Ledréau, I am leading FM Global for the Paris operation, working for FM for 27 years. And so sorry to not be present with you. I'm looking forward for the session. It will be a little bit challenging because being remotely, it will be complicated to connect with you. And but I can assure you that I'm very engaged and looking forward to share a little bit of what I've learned in the US last week and to share with you. But sorry for this lack of apparent engagement. We'll try to do my best, but I can assure you that behind my screen, I'm with you.
Thank you, Loïc. So at the top of the pyramid, you know, beyond insurers, there are very important actors, and you know them. It's called reinsurers. For the reinsurance side, today we've got Frederick that is going to introduce himself.
Yes, so thank you for the introduction. I'm Frederick Durst. I work for SCOR. I'm the CEO of SCOR Europe and head of EMEA for Specialty Insurance SCOR. So my title is not very self-explanatory for the reason for me to be here, but before I spent 8 years in New York City leading our operations for North and South America. And obviously, US was the biggest market for us, so I'm happy to be here. Thank you for having me.
Thank you, Frederick. And last but not least, we've got a representative from Sedgwick. It is very important, you know, the role of the third-party insurers in the industry, and particularly in the US with a specific exposure. So we have the chance to have with us David, that were supposed to come also from the US, but like Loic, he was facing some positive issue a couple of days ago. So David, you want to introduce yourself also?
Absolutely, and good morning. Can the panel see me? Yeah. Or it's just voice?
They can see you.
Okay, very good, because it's 2 a.m. in the United States here, and I've got a suit on, and I wanted to get credit for having a suit on at 2 a.m. in the morning. Really glad to be here with you today. Sorry I couldn't be here in person. Maybe next year, when we get through all this COVID business, we'll be able to come in person. But, again, it's 2 a.m. in the United States here, so this perspective on the U.S. is going to be about as fresh as you can get. On me, I'm a long-time global risk manager based in the United States. Real quick background on me, I'm a licensed attorney and a certified public accountant with about 30 years of experience in the legal and the risk management industry. Practiced law for about a decade, and in 2002 I joined Walmart, leading their global risk management division, staying there until 2020. At Walmart, I had responsibility for the casualty claims in the United States, so the workers' comp, general liability, auto products liability, et cetera. Had responsibility for the global insurance placements for all lines, insurance coverage, claims and recoveries, and also executive leadership of Walmart's captive insurance company. I joined Sedgwick in 2020 as Senior Vice President of Carrier and Risk Practices, where I focus on carrier and large corporate clients, including multinational clients like you all. I work with Sedgwick's international teams to expand our business to help us serve clients around the globe, and I focus on litigation strategy and how we can improve outcomes for our clients. If I could take just a second about Sedgwick, for those who might not be familiar, we're a leading global provider of technology-enabled risk, benefits, and integrated business solutions. We have about 31,000 colleagues in 65 countries. In 2021, we handled about 11 million new claims, about 9,000 clients around the globe. We have a strong presence, obviously, in the United States, but also in Europe, Middle East, Africa, Asia Pacific.
Okay, so thank you, David, for this introduction. So you know that this year AMRAE is focusing on the new takeoff risk and opportunities, and what we can say is the fact that the plan USA is already in the air, and we want to share with you our vision of the 22 roadmap. And we want to start with the first slide with the US priorities. And for that, we try to find a way to introduce the things that we want to share with you. And the best way was coming from the US Chamber of Commerce, that is illustrating perfectly what is on the roadmap for the US for 2022. So just maybe to start with you and to do the interaction with you, what do you think that we can find on those priorities? Maybe one or two persons in the audience can share what could be for you some of the topics that are part of the US priorities from the trade perspective. An idea? Manuel, an idea? Supply chain, employment. Other ideas? Yeah. Yeah.
There's one more.
And one more? Yeah. Yeah. So in fact, so we are going to share. So the first thing is the fact that for the US chambers, considering that the COVID-19 will be behind us very quickly, based on the fact that the effect of Omicron is for the time being very limited in terms of side effects. So for the Chamber of Commerce, they're already in the next step, considering that the COVID-19 will be behind us. After that, in terms of perspective, thank you. In terms of growth, the Chamber of Commerce is considering that the growth will be similar to 2021, and it will be a record year. In terms of inflation, you know, there is a big debate that we are going to tackle. Are we, in the US, it's particularly important, are we going to face transitory or, I would say, non-transitory inflation? But for the Chamber of Commerce, the inflation is something inevitable and appropriate. And one of the topics that is also very important, you see that the US public debt is significant, quite significant, representing 130% of the GDP. The trade booming is expected. You've got the figures just on the screen. And there are also, as it was mentioned, the concern with China. So from the US perspective, in fact, US is considering that China is a big partner for the Asia zone, a very important player. So there is a kind of move to, of course, to find a way to really be focusing on the business and try to let the tension a little bit come down, again, from the trade perspective. The US want to really focus on finding new trade agreements between different actors. It's a big move that is still going on. And the US want really to be an active player to find new way to really obtain very good trade agreements, and trying also to use the model developed by the European Union that is the most today. This is the most actor that negotiated the most important number of trade agreements. There is also, in terms of investment in the US, there is a rebound, I would say. So it's a very important still on the roadmap. But what we want to share with you, it's a little bit the big transformation that are going on. And this is the thing that on which we are going to develop a lot of things, a lot of ideas beyond risk and opportunities. And you've got here the what we want to tackle, the US supply chain, as Emmanuel was highlighted just before. With the willingness to normalize, but there is big challenges in the US supply chain that is going to be tackled by Loic. And so the national security, it's of course interesting to see how the US are going to repositioning themselves after the disaster of the Afghanistan, and the Ukrainian situation is going to be a good example to see how the US is going to behave, and to also to anticipate the next crisis that is going to come, probably linked to Taiwan in the coming months. National security is also the cyber concern, with a lot of attacks in the US, and it's also a priority to secure and to reinforce based on the various threats, to reinforce the security. Digitalization, it's everywhere, you know, in every industry. So really in the US, you can see that the US want to focus on finance and healthcare and the use of intelligence, and they want to be a leader in that area, to fight trade barriers, particularly in the data world. And based on the description I was making on the trade agreement, what the US want to achieve in 2022 is to find a way also to negotiate digital trade agreement. Energy transition, so the US really want to be a leader in that aspect, and you can see that they want to focus on energy storage, advanced nuclear, hydrogen, and they are already focusing on the impact of the climate changes, and they want also to be a leader in that area, and they are focusing on strategic minerals also that are clearly identified, such as cobalt, copper, lithium, nickel, and rare earth. And they want to be sure that the supply demands will be met. So the panel will tackle those transformation, and also what we want to do is to do the comparison with the insurance industry and the various challenges. And for the US economical perspective, Frederick is going to take the lead on this one. You know that in the US there was this big move to support the industry with a lot of investment that has been made by the state, also in terms of fiscal incentive, and this will be over. And we know that the growth is there, and Loic Frederick is going to start with the main indicators and to share the view of what we are thinking that is relevant.
Thank you, Cyril. First of all, I'm not an economist, so please bear with me. I try to do my best to explain what I think or what we think during our rehearsal that is relevant to our industry, insurance or risk management, because a lot of the terms that we already talked about, like employment, inflation, the tension in China, and they have consequences on the economy and ultimately on the business and on the insurers and risk managers business too. So I'd like to review some of these key features that make the economy in the US interesting to discuss today, and during the course of conversation we will try to see how they actually connect to our industry. So, as Cyril was saying, the economic outlook is good for the US in the shorter term. I think it actually, in most Western countries, everybody bets for a growth of about 4%, which, by the way, is quite similar in Europe. And you remember last year in 2021, there was a very aggressive movement from the US government to actually, for the recovery in 2021, injecting massive amount of money. I don't know if you remember, but sometimes figures are just in the air and we got a little bit dizzy about them. But they actually injected $5 trillion in the economy. $5 trillion is 20 or 25% of the GDP. It's a massive investment of money. So the reason I'm saying this, because everybody talks about inflation, but this is one of the consequences of the inflation. 2022, again, as I said, looks good. It's pretty positive. The action of the government is quite similar, except that this is a little bit more focusing on two very identified landmark legislation pieces of Joe Biden administration. One is, you probably heard about it, is the infrastructure bill that was voted, I think, back in November for $1.2 trillion after a lot of negotiation. And the second one, which is still under negotiation, and it looks like it's pretty hard, is the BBB, the Build Back Better. And what's interesting, and I think it's 1.5, I mean, it moves every day because of negotiation among the different parties, and even among the different movement inside the Democrat Party. But what's interesting is that those two bills are supposed to really boost the economy in real terms. I'm talking about manufacturing for the first one, for the infrastructure bill, professional services, jobs, and the second one, the BBB, is more focusing on climate change mitigation investment, which is also very interesting for us because it creates a lot of opportunities in the risk and insurance industry. One of the risks that is still hovering over there is the capacity of the administration to actually pass that legislation, because there are talks that if it doesn't pass the way it is now, if it's a little bit reduced, or if it takes longer, that could actually impact the GDP of 0.5% or even 1%, so it's quite impactful. The second thing that you hear about the US and in Europe as well is the monetary policy, so money and inflation. So clearly, inflation is the biggest threat for the US economy growth trajectory. It's also a very, very big threat for the insurance industry, and we'll develop that later on. I don't know if you remember, but back in, I think it was after summer until December, the inflation went up and down, but it was at 5% on average, and it went all the way up to 11%, I think, in December. So it was really, really something we haven't seen for 40 years, so quite gigantic inflation. And this is why the Fed quite recently decided to actually wind down the quantitative easing process and also anticipate to raise the federal rates at something like 2.4%, which again is the average that we would probably have in Europe, but earlier in the US, because they're talking about March for the first hike, and then there will be multiple hikes until 2026. The big question, and that's something we can discuss today, is that this inflation, is it temporary or is that lasting or lingering? And somebody mentioned the employment, and that's exactly the key. In the absence of wage indexation, things will be good. Everybody, all the experts, the pundits, the insurers, the reinsurance, the analysts, they think that the government or the central bank have everything in hands, and they will be capable to, master this inflation. But we don't know. And if for example, the environment is such that workers are asking for, outsized wage increases, then it's a different story. So, you know, this is the reason why we're here. The inflation, which is more classic than you know, it's bad for the industry, as you know, because it's increasing the cost for the industry like yourself, the cost of goods sold. For us, it's the cost of repairing, of indemnifying, the insureds. You know, for our investment, we'll get to that a bit later, but inflation is bad. And if if things turn really bad, it will get to a recession. Exchange rate, very quickly. The real effective exchange rate is actually high in the US. There's no surprise. You know, the US dollar is strengthened by the US fiscal stimulus. There's so much money in the US, and the economy is rebounding so fast that everybody is investing in the US. So, you know, dollar is going up. Another thing that people mention over here is the geographical or the geopolitical tensions. Russia, Ukraine, China, everything. So, as usual, you know, the US dollar is where you put your money if you want to find a safe place. But again, you know, everyone has to watch about this wage price spiral, which is very important. So, last point that I want to mention to you is, and maybe there are some representatives of this of this sector over here, is energy. So, as you know, energy is soaring, and the rise again can be the rise of this price can be blamed for a variety of things. And again, this is the rebound. This is the post-pandemic. Everybody's buying at the same time. You know, tension in Ukraine, and as you know, Russia is a big producer of gas. But, you know, something I wanted to mention to you, and maybe we'll get to this, is after the pandemic is away, after the crisis in Russia or some other places is away, there's still a big element that would probably drive that energy cost pretty high, and this is the climate policies. And that's something that is very relevant for European as well. When you talk about net zero emissions, it has a cost. And I think the US was pretty advanced in measuring that cost. There was a study that was done in the US where, and I think the number is pretty good because it tells you in real terms how this is costly. If you want to achieve an 80% reduction of emission by 2050, it will cost for the US economy $2.1 trillion. It means $5,000 for each and every American every year until 2050. So, you know, as a Frenchman, I was thinking, remember what had happened when the government wanted to increase the price of diesel fuel in France, and the yellow vests came to streets, etc. And, you know, doing the math, it represented about 12% of the cost of fuel. And here we're talking $5,000 per American household. So it's not an easy question, and that's probably something that will still remain as a big driver for energy costs up, and then inflation. That's it for me. I hope I wasn't too long.
No, it was very well detailed. Thank you, Frederick. So you have seen that on the inflation part of a quicker slide on the consequences on the insurance side. So Loic and David will come back on the specific during specific slide how we can anticipate some consequences that insured should take into consideration. So what we want to do right now is to transpose this potential growth to insurance industry, and for that we'll let Tina also share the view where you know, based on such environment, how a leader like Chubb is standing and related challenges.
Thank you, Cyril. So I think it's important that we take a look at the overall insurance market, the trends we're seeing, and what we expect to see in 2022. And there's a lot of characteristics at play that are impacting the market. First and foremost, we have capital. The industry, it's awash in capital. There is plenty of capital, and we are in a very strong capital position. However, just because we have this influx of capital in the P&C market, it doesn't necessarily mean that we're going to see an immediate shift or shortening of the hard market cycle that we've experienced in 2021. In fact, we expect it to continue into 2022. And the reason for that is because there's a lot of other factors that are at play right now in the insurance market. One of those is the low interest rates and low investment yields that we're getting on our investment portfolios. It's putting a lot of pressure on insurers to generate underwriting profits. And if you look at the chart, yeah, I think you can see it up there, the blue bars at the bottom, they are representing net investment yield on invested assets. So in 2021, it basically was 2.7%, and that was flat versus what we saw in 2020. But if we look at 2019, it was 40 basis points above what we came in at 2020 and 2021. And the overall trend line is going down in that portfolio. So on top of this low return in interest rates, we are also seeing adverse losses, and those are developing both in the liability side, and it's also developing on the property side, particularly with cat losses. And Loic, I don't know if you want to add anything on that?
On the rising costs?
No, I said Loic.
Oh, yeah,
I don't know if he wants to or not.
Yeah.
Yeah.
No, I can only echo what you are saying, Tina. On the property side, in terms of losses, the cat losses is clearly a big driver. When we see, as mentioned by Cyril earlier, I was in the state last week. Just over the weekend, in between Boston and New York, more than 7,000 flights were cancelled due to the snowstorm. And so we see in the States a massive amount of natural catastrophes, and we will come back to this earlier, to this little bit later. Sorry. If you remember, also December was quite volatile in the States in terms of natural catastrophes. If you remember, the big tornadoes in Kentucky was another impact, and in 2021 we had already several hurricanes, and we started the year with the big freeze in Texas. But we'll develop a little bit further, and maybe the next step is to look at what we can call emerging risk on the U.S. market. So I don't know if we move to the next slide, or if we.
No, there are a couple of things that we want to tackle.
Just a couple. I don't know if you could hear me. Just a couple more things. So the other things that we really need to consider are on top of these low interest rates that we're seeing, we also, as an industry, we're experiencing poor underwriting results. And there's simply just not enough return for the overall risk and the volatility that a lot of insurers are absorbing right now. So, and I think...
And we have this combined ratio, this slide maybe is a good illustration, because beyond our market condition and so on that we are experiencing, and a little bit frustrating and challenging for insured, I think that it's important also to have those figures in mind. So, Frederick, maybe you want to...
No, I think it's pretty self-explanatory, and I totally concur with Tina. Is that, I mean, it's obvious when you see the diagram, you have the traditional cycle, it's still a cycle, but it's flattening, which means that, profitable years that are supposed to finance the non-profitable years are now thinner and thinner.
Mm-hmm. Exactly. Yeah, and then of course we also want to look at the return on capital, right? So again, a lot of capital in the market, but I think what most of you might have experienced in 2021 is a reduction in capacity from some carriers, right? Not having the capacity out there. And quite frankly, carriers are being very selective on where they are deploying capital. If they are not getting the adequate rate of return on the capital, they're going to pull back. And I think, again, that trend is something you're going to continue to see in 2022. And I think you're also going to see this continuation and theme of rate adequacy, return on adequacy and rate, and again, that is something that will continue forward in 2022. The other consideration are reinsurance costs. Again, plenty of capital in the reinsurance market, but the reinsurance companies are in the same position as the insurance companies, right? Not enough rate return. I don't know if Frederick, you want to comment?
Yeah, it's exactly what you say. There's not a lack of capacity per se. Maybe there's a lack of capacity as being usable, but the capacity is there. I mean, the industry has been traditionally very well capitalized. If you see, the different publications from the brokers, I don't remember the exact number, but I think it's like $600 billion. The problem is a risk aversion issue, is that the traditional investors and even the retrocessionaires and the reinsurers, now they are much more prudent and cautious because they really see the natural catastrophes, which is the core business of reinsurers, as a main issue, and we'll get to that. And as Tina was rightly emphasizing, the low interest rates, and I'll give you a number. Traditionally in the P&C industry, 75% of your income come from the investment. That's you know, a ballpark number, 75%. You don't have that number anymore. I mean, now, you know, you probably have 5 or 10% in good years. So that kind of low gains muted the investment gains that you usually have in the past. And I'll give you something that is more a view from SCORE, but I think it's actually something we could share with the other reinsurers, is that because of the inflation, and as you know, insurers and reinsurers have their portfolio invested in bonds, you know, fixed income type of instruments. And what most of people in the industry did to insulate the portfolio from the risk of inflation is to reduce the duration of your portfolio, because everybody knows that if you have an increase of rate of 1% of your portfolio, if you're, for example, you have a 1-year bond, the bond will decrease the value of 1%. If you have a 10-year bond, just for 1% increase of rate, you lose 10%. So everybody reduced the duration of the bonds to protect from the inflation, but the problem of that is that you actually reduce the amount of annual returns as well, the return you can make on the investment. So you either on the balance sheet on one side or the other one, you're losing. So
yeah, you're absolutely right. You're stressed on both sides. You're stressed on the investment side and you're stressed on the liability side, right? Which is when we're putting out policies assuming risk. And typically insurance carriers, reinsurance companies, we're investing in low risk, low reward bonds, treasury bills. So if that's not making money and we're stressed on the liability side, on the underwriting side, we're in trouble, right? So that's really the crossroads what we're seeing. The last dynamic I would add is this increasing rise of loss costs. The loss costs are rising. We're seeing a rise in frequency. We're seeing a rise in severity, cost per claim, and this is across many different lines of business. So it's not just one specific thing. In the United States, we're seeing a lot of losses trending in motor and in auto liability, which I know we'll talk a little bit later on. I think David will share some information on that. But you add all this up, right? And I don't want people to walk away doom and gloom, right? The market is stable, it's secure, it's positive. But we have a confluence of different factors, right? Poor underwriting results, we have reduced capacity, we have low interest rates. We didn't even talk about COVID. There's a bit of a COVID hangover and some uncertainty going forward. And we also have the emerging risks that are coming out. This uncertainty of cyber, climate change, and how we're addressing that. So a lot to think about, but I think everyone in this room, whether you're reinsurers, whether you're insurers, whether you're a client, a broker, I think we all have a part to play in this to make a smooth 2022 and as best as we can.
Thanks, Tina. So you were mentioning emerging risk. So there are visible ones in the US, and it's leading to, I would say, a kind of crossroads for the insurance industry. So this is something that we wanted to share based on what we prepare for this presentation. And I think that Loic and David, you are going to talk a little bit about that, starting with the climate changes risk. So we just tackled that just before, but I think that what is important is what's going on in terms of financial disclosure linked to those risks, and the rising of the SAG also factor. I think for us, what is important also to highlight is the fact that some insurers are making really some investment to support clients with specific studies on climate change's resilience. There are a lot of things going on, so I think that it's important also to know that as a client, when you are facing this internal concern that is very important. I'm a member of the Sanofi Climate Changes Committee, for example. It's really important to have the input of the insurance because it's key, because the insurers and the reinsurers, they have the data to bring support, and there are a lot of initiatives that we wanted to highlight. Loic, you want to say a word on the supply chain and the as a kind of emerging risk? We know that there is something going on, but you wanted to share some messages on that?
Yes, I think the main emerging risk that we are seeing today coming on the US market, but that also are present in Europe. Climate change is for sure one of the top. Just before we mentioned the fact that we see every year we see an increasing amount of natural catastrophes. So ESG and sustainability in particular will for sure remain as very high on the boardroom agenda. We'll discuss a bit later about some trends in terms of claims and losses, and I will be able to develop a little bit more about the impact of climate change and natural hazard catastrophe. Supply chain is for sure a key risk, and the disruption that COVID-19 brought on the supply chain over the last 2 years will very likely continue into 2022. And another risk that I don't know if you can call it emerging, but is the fact that the pandemic persists. And I think yes, it's important to keep in mind a few words and a few numbers. At the beginning of 2022, we had close to 5.5 million of people who died from COVID-19, out of closely 300 million of people contaminated. And there are already very large numbers. And what the vaccination campaign has progressed steadily in a part of the world, but unfortunately not evenly throughout the world. And currently we have about 50 countries who have vaccinated more than 70% of their population. So it means that on the planet we have still large areas which have not been vaccinated and many people not protected. So it means that the virus continues to propagate in this country even more rapidly, will create more deaths. And I'm not a specialist of virus, and the virus may continue to create some mutation and can challenge the country who are better protected. Yep. So there is a lot of uncertainties about the pandemic risk and the fact that the pandemic persists.
So the financial markets are quite optimistic, but what we are waiting for, as you can see, is really the switch and the signal really made by governments about the switch between pandemic situation to endemic. And this is key, and for the time being, this message is not so clear. So.
No, cyber is obviously a very important aspect and part of the risk that are very present on the US market and also present in Europe. But what we see that insurers on average are reducing their coverage while the demand is increasing. So we have here a problem of adequation between the supply and the demand. Insurers have not been able to charge. I've been able to charge higher rates, but for the cover they are provided. But they are very, very, very cautious and about this coverage. So here there is a clear risk, and it is aggravated by the digitization of the economy and all the interactions that we see in our day-to-day life. And I will come back to this later with when we speak about the supply chain.
Yep.
And I think
that this is
yes.
Loic, you wanted also with a few with Frederick also and Tina, you wanted to share something that is rising is the on the workforce, particularly in the insurance industry. There is an ongoing talent wars and specific needs. You were mentioning risk concentration and digitalization. So there is this switch, very important, and the client's expectation around that with a huge transformation as we were discussing. So can you just illustrate a little bit this concern about insurance talent wars and the shifting, impacting the operating models?
I don't know if you have heard, but what we are seeing in the state currently is what is called the Great Resignation. So we have workers, they decide from one day to another to stop working. They resign. they go for another company, or they go to do something totally different. And we had already before, is it a consequence of the pandemic? Is it a generational issue? I don't know. But the fact is, there is a lack of talent within. It's not only with the insurance industry, but it's particularly true with the insurance industry, because the insurance industry is also shifting model and is using more and more technology, and we have to shift from I would say the classic way we used to develop the core competencies that the insurance industry needed, underwriter, claims, data analytics, and we used to have a kind of classic, long-standing apprenticeship, and this is no more. This is no more. This is more and more complicated to keep this type of model, to develop and to retain, to develop the talent that we need to run our business, but also to retain the talent. So there is really it's a rising risk and emerging risk for the insurance market.
So we can say that we can say, as an illustration, in the pharma biotech industry, for example, we decided to move ahead and to, for example, in France, we try to work on the specific training and to have the future employees of the company working on the biotech side, including on the manufacturing. So maybe there is something that we can build with the different insurance sectors, between insurers, reinsurers, brokers, third-party loss adjuster, to have a kind of training, a specific educational, I would say, roadmap, and to attract future talents that will be the future of the industry in terms of fulfill the needs. And so maybe there is something interesting behind. The time is running, so I will try to speed up a little bit. The other things that on this slide we wanted to tackle is really, Loic was starting to talk about cyber, that is, very frequent, and everyone is talking about that. But I think that what we can see in the US is the kind also the things that we are switching from a crisis to another. And over the recent years, we can see that we are jumping into cyber crisis, and after that there was the pandemic, and there is the supply concern. So I think the job also and the challenges are also linked to the fact that it's starting to be a little bit natural to manage crisis after crisis, and this is something that we wanted to highlight. I think that the next slide is focusing on the supply. So this one, again, is we will try to interact. We want to share a few ideas. So the first one, maybe, Loic, is the fact that you want to share figures about the current, for example, goods that are stuck in the San Francisco seaport, just to illustrate the figures that we are talking about.
Yeah, maybe we can make just to speak about quickly about the goods that are stored. In fact, in front of Los Angeles, the Los Angeles port is at the end of last year, they had about $24 billion of goods in containers on cargo ships waiting to be unloaded and to be shipped throughout the states. It's a significant number, and the reason why it's linked to the story of the COVID and how COVID accelerated trends that were already in place before. And it's fascinating to see how quickly our environment and our interaction have changed when COVID arrived. One of the first impacts the pandemic had on our day-to-day life, to all of us, and also to our companies, is the fact that suddenly we had to stop almost all social interaction. We stopped traveling, and a significant part of the economy just and because the purchasing power of in the States and in Europe have been maintained by the government, the demand and the individual demand may continue to be very high, but because it was not going towards leisure and social activities, it concentrated really on interconnected products and online servicing. And one of the reasons of having this amount of stock in Los Angeles Harbor, in front of Los Angeles Harbor, was the booming of the e-commerce. The e-commerce has never been so strong, and so it created a massive amount of a saturation of the supply chain, and the fact that we concentrated also on the e-commerce, on interconnected product, a big also demand in terms of electronic components. So
yep.
and we now for several. Sorry.
Yeah, the booming of the e-commerce is also for every company is very important, because in terms of stock and transit claims, for example, some very important actors such as FedEx were facing some issues in terms of resources due to the booming of the trading. So and today with the COVID also there is this concern with the number of trucks available, the pilots that were not able to take the lead on their job because they were facing COVID. So there are some bottlenecks, and in the same time, it's the situation, as it was mentioned by Frederick, the concern of the US infrastructure is very strong. Some of the seaports that we're mentioning are ranking in the list 350 ranking compared to other areas. So this is a big concern for the US.
Yeah, and there's just an anecdote, because it really comes from the US, and everybody knows Amazon. You know, Amazon is the champion of the cloud. This is the biggest cloud provider, but what maybe few people know is that their massive investment at this point is aircrafts and trucks. They are building a huge fleet that would be comparable to FedEx, as you just mentioned, and trucks, because the last mile is the most important in the supply chain. Yeah. And they found out that it was a problem for them. It was problematic. So now it's funny to see this digital company coming back to the sort of a traditional industry.
Yeah, and speaking about trucks, on the US market, there is a shortage of 100,000 lorry drivers. So if your dream is to drive a big truck in the States, I think there are there are job opportunities there. I just see you can see on the slide the Colonial Pipeline, and it's an example also of the criticality of cyber, and the fact that the pandemic opened even more the online activity that our company, we all put when it's possible, we work remotely. It created more opportunity for the cyber criminal, and we have seen over 2021, and there is no reason it will stop. More a very high increase and a big hike in the term regarding cyber attack. Some are very, very, very famous. The one from Colonial Pipeline was around May, I think, where more or less the distribution of oil was stopped in the south part of the States. So it's today we see cyber criminals. They can really go into the what we call the industrial control system of their organization, of clients' organization, and they are very very thorough and very impactful.
So maybe 2 quick comments on cyber, because you are all knowledgeable in the session about cyber risk. But just to illustrate that logistic type of companies were fully targeted during the COVID-19, it's done in purpose. What we can anticipate, and this is something very on the very highlighted in the US, is the fact that the cyber security will be a key assets for the future. So this is why there is a rising of unicorns in the US that are able to have obtain a huge capital investment. You can see the needs that are illustrated by these slides about the figures that we are talking about, but also something very important is the fact that the cyber claim experience over the last 2 years, and the fact that we decided to have a new way of working and to work remotely, it was also the main cause of the claim experience, because the hackers were taking advantage of this situation. So what we can anticipate on the insurer side and the client side is a lot of pressure on the information about the security ecosystem, and I think that will be key for the future, including the potential partnership between the insurance industry and the insured, is the fact to find a way to define some very strong standards in terms of cybersecurity and to have very strong companies in that area to be sure that we can be reliable and to be sure that it will also bring you help to have and to maintain capacity for this type of risks that are critical for a lot of us. You were mentioning also the NatCat experiences, Loic. So this is this slide.
Just to create more complexity on top of all what the e-commerce, the fact that it created more opportunity for the cyber criminal, and also e-commerce put some tension on all the distribution network of goods. On top of this, you have the NatCat environment, which is very present and create even more perturbation to the global supply chain. I think the pandemic is kind of a practical demonstration that risks are really interconnected and cannot be seen in silos. They are all together. And regarding the supply chain, I think it's very it's critical and it's imperative for clients to understand and identify their supply chain. There is a need to make a real mechanical analysis of the supply chain to look at all the link of it and to find out where is the weakest link and in order to prevent and to make the supply chain more resilient. We have seen over the last 2 years the clients and the organization that anticipated and who had a holistic view and a very detailed analysis of their supply chain have passed the COVID-19.
And I think, Loic, you wanted to share the example of Tesla. You know that Tesla succeeded for the full year 2021 result, very successful. You know that the concern with the semiconductor and all the electronic equipments. The Tesla car is mostly technology driven. And finally, you have seen that Tesla was not impacted by the supply chain concern. So this is something that you wanted to highlight, Loic, in terms of vertical supply chain.
Yeah, no, I think not much to say. The fact that is exactly what I try to illustrate, and Tesla is one of the organizations who had this view of their supply chain, a global view of their supply chain, identified the key area of their supply chain, which are critical and which are the most vulnerable, and they integrated this part in. With BCPs and with redundancy or they reintegrated technology in different places to avoid the shortage of goods in terms of tension on certain products. So Tesla made apparently a very smart and very efficient analysis of their supply chain, because compared to most of the industry, automotive industry, very few have been capable to continue to produce and to deliver their product on time over the last few months, and you can say few years now.
Okay, so I think that the meeting room is all the people are now fully trained about this US supply chain, still disturbed and what's going on. So we are going to switch into another US hot topics with David and Tina. And you will not be surprised by the fact that we want to talk about the ongoing transformation of the US legal system and the social inflation. This was also part of, at the beginning of the meeting, some of you already identified this specific concern. So we know that this is the end of the pandemic, and the jurisdiction, US jurisdiction, will be reactivated and coming back to normal activities. And in the insurance industry, there is this rising concept year after year. What we are talking about is the fact that there is less predictability in terms of verdict and settlements. And I think that our US folks are going to explain a little bit what is behind, and do we need to consider that this trend is just the beginning, and things are going to continue to increase, and with the specific exposure. So, so David, maybe you want to talk about a little bit about the social inflammation and the legal system transformation based on the slide that has been prepared.
Yeah, absolutely. And, you know, Tita mentioned earlier the rising claim cost, and a lot of that is blamed on what we call social inflation, which is really a buzzword for the situation in the United States, marked by, as Cyril mentioned, less predictability in litigation outcomes, a general rise in the size of jury verdicts, and the more common occurrence of large or super large verdict that we call nuclear verdicts. You know, it seemed to have started probably 8 to 10 years ago, and in specific parts of the United States, I think of Cook County, Illinois, Southern Florida, parts of California. But at this time, it's pretty well impacted the entire country, and there's really no indication of it waning. It's impacting all liability lines, whether it's general liability, auto, products liability, contracting claims where lost profits are at issue, directors and officers insurance, employment practices, and, you know, and the list goes on. And it's not just the verdicts, it's also the broadening of the definition of liability. You know, we see cases that previously we would have thought had razor-thin liability facts being allowed to go to juries, and then, you know, findings of legal responsibility by the jury. There's a lot of, you know, thoughts about what causes it, and some of them I can mention is the perception of the value of money has changed. One issue that's often blamed is litigation funding, which is much more prevalent now than it has ever been. I mentioned judges letting paper-thin cases go to trial, the extension of the definition of liability. And, you know, I think a lot of credit goes to the plaintiff's bar. You know, they are sophisticated, they're coordinated, they work together, and they run a really good business. They advertise. I think advertising has an impact on it. On the other hand, the reputation of corporations and big businesses generally is not as favored with juries. And speaking of juries, the makeup of the jury has changed. You got more millennials and more Gen Zs in the demographics. You know, finally, I've mentioned the erosion of tort reform. There's just very little going on today in the area of tort reform. So, you know, that's what we're seeing.
Yeah, and Tina, maybe you have some.
I mean, I would agree 100% with what David said, and you know, we talk a lot about, I think, natural catastrophes, right? So this whole idea of runaway litigation, legal costs rising, plaintiff's bar, where it's all trending, that's what I would consider a man-made catastrophe or self-imposed catastrophe. And David mentioned it's all over in the United States. It's also very prevalent in the UK. It's made its way to Australia. We don't see it right now on the continent, and let's hope we don't. But the reality is that these lawyers, they're looking for deep pockets, and they are looking for the next place and location that can happen. And guess what? Europe is going to be their target. So your U.S. is playing defense, right, with this because it's been there, it's prevalent, it's been there a long time. We don't want that to happen right on the continent. But, you know, David mentioned a lot of these drivers that are going on, the social inflation drivers, and he touched on just about everything I had. One other thing he said was he gave credit to the plaintiff's bar. And I would give credit to the plaintiff's bar, too. They're getting very savvy with the way they are using social media, the way they're using technology, the way they're sharing data. Not only do they use social media to advertise and numb everyone, right, with these high verdicts that are coming out, and whether or not they're even true or real, it doesn't matter, it's numbing us. They are using social media when it comes to how they actually defend a case. And they're using videos, they're using the videos, they're using, the millennials are using that. The defense lawyers in trials are still doing this long expertise of trial and the way they're playing out complex issues. It's just a very long and I'd say old school way of doing it, where again, you're seeing much more data with graphics, virtual reenactments, right, with the plaintiff's bar. So they're very savvy, and I don't think this trend is going away. In fact, we look at it as one of the global systemic risks and uncertainties, just because it's it's been trending upward. Now, if you look at overall money, the money that has been spent on the courts and the number of cases, it actually decreased in 2021, but it's simply because courts were closed. So we are expecting that to pop right back up as soon as the courts open.
And maybe to illustrate that what has been said is the fact today to have a verdict with or a settlement raising 100 million, it's not considered as a kind of punitive type of verdict by some. So there is a switch, I would say, which is linked to the disparities, the growth inequalities, the new generation, and so on. And the fact that since 2019, we have seen an increase by 300% of the frequency in terms of, median type of amount above 20 million USD. And this is a strong increase compared to the period 2001 to 2010. So we can see that the inflation is still rising. And I think that there was something important that you want to tackle, David, is the question of the funding, which is key this global under those global circumstances.
Yeah, absolutely. And that, funding is, it is really just people investing in litigation and the outcome of litigation. And it's an asset or a resource that the plaintiff's bar has today that they perhaps didn't have even 5 years ago. And, as it started, it was generally first litigation funding for particular cases. Maybe it was a large employment security matter, or maybe it's more likely a more directors and officers claim or securities class action. But what we're seeing now is that the litigation funding will fund a portfolio of claims for a law firm. So they'll take take the whole book, not just one particular case, which really, it really steeps up the assets of the plaintiff's bar to work on these cases.
Thank you. So, Frederick, you want to add something?
I just wanted to sort of close the loop and come back to finance, and because you talked about the funding of that, we're talking about money here, and I think one thing that we have to keep in mind that we have two kinds of inflation right now. The economic inflation, we spend a lot of time about that, which is CPI index related or employment or interest rate. And this kind of inflation is more or less easy to track, but the social inflation is not easy to track. Because you're talking about, millennials, propensity to sue and that kind of things. And I think the net result ultimately is a change of the estimated size of the outstanding reserve that we have within the insurers or reinsurers, which is the severity of the claims that we will see in the future, but also the increase in the pool of exposures. So this is a frequency. So that explains why now S&P, for example, is changing the way they are assessing the reserves of insurers and reinsurers. It's not only natural catastrophes, it's also liability claims because of social inflation. So it's real. It's not just a sort of a buzzword that you could read, in the New York Times. We're talking about social inflation. It really has some financial consequences and ultimately cost results.
So, right, to end on this slide, what will be key also for the future is how we are going to integrate the ESG type of factors inside, because you've got the image and reputation, but if you are not fighting in front of those courts, I mean, you will pay a lot of money. And you know that the insurance industry was also very pushy to find some settlement quickly, just to be sure to avoid the less predictability concern. So we will see if this ESG factor introduction will change a little bit also the picture, but I think that on our side we will continue to fight because there are a lot of the financials at stake is very important. So so that's very key, and for us it was key to share that with you. Now we wanted also to do a quick overview of the claims going on in the US for specific type of exposure. At the beginning of the crisis, the insurance industry was considering that the COVID global claim experience will be above what we have seen with the 11 September or Katrina
hurricane.
Yeah. And we wanted to see what is the current reality, and particularly something very visible is on the workers' compensation. Even if you are not listed in the US, every client having some employees in the US have to deal with workers' compensation. So David is going to share his vision about the current situation.
Yep, great. Now on your presentation on the screen, you'll see the map of the volume of workers' compensation claims handled by state by Sedgwick. Sedgwick probably handles about 65% of all COVID-19 claims in the United States, so you can extrapolate these numbers and kind of get a sense for the overall U.S. volume and trends. In total, Sedgwick handled about 2.9 million COVID-19 claims since the pandemic began in 2020. The highest volume for workers' compensation are California, Texas, Florida, and Michigan. And with the exception of Michigan, this volume pretty well mirrors the population size of these states. Sedgwick also handled about 2 million paid leave claims. On the workers' compensation side, the volume peaked in about December of 2020. Then it was almost as high in January of 2021, and then it fell. Then there was a small spike in July, August, and then it came back down. And then, unfortunately, the claims started to rise again in December 2021 and then continuing into January. There's spikes on the workforce absence side. On the workers' compensation side, the main industries impacted were the healthcare, as you would expect, the public sector, and retail. So on this slide, it shows the stats for some of the COVID claims handled by Sedgwick as of December 31st. To this number, you could add about 20,000 workers' compensation claims for January. Most of these claims are closed, with the denial rate varying significantly by industry and depending on what state you have and whether there's a presumption law in place. You had about a 50% denial rate for retail versus about a 23% denial rate for the healthcare nationwide. California, New Mexico, North Carolina had some of the higher acceptance rates, whereas Oklahoma, Minnesota, Virginia, Alabama had some of the lowers. Most of these cases closed with very little cost. 57% had no indemnity or medical pay. Most were expense only or quarantine. So what you have is a vast majority of the cost is associated with a small percentage of the claims. And a lot of those were the older people, obviously, the longer cases, et cetera. The hardest hit, again, was the healthcare. In terms of demographics, it was pretty well evenly split among the ages.
So David, do you want to maybe to share your point of attention maybe for specific locations that are well known, such as California, Florida? Are there some trends that you want to share with the audience?
Yeah, on the liability side, it's different than the workers' compensation side. You don't have as much of an impact of social inflation in the workers' compensation space. Workers' compensation is very state specific, so it's harder to compare state to state. But clearly some states are more costly from a workers' compensation perspective. And there's several ways to measure it. You can measure it by the insurance rate per employee hour, the premium, or the claim cost. So if you look at the rates, the highest states are Alaska, Montana, California, Hawaii, South Carolina, and Idaho, whereas the lower states are District of Columbia, Texas, Arkansas, Indiana. And if you look at it from a loss cost base, if I took Sedgwick's paid claim data, average paid per claim for the last 3 years, the top states are Louisiana, Hawaii, New York, Illinois, Pennsylvania, and South Carolina. Florida and California are expensive, but they're not in the top 10 from that perspective. That's not to say that there's not pockets of California, and certainly Florida, that are really problematic, like the Miami-Dade area in Florida.
Okay. I think that the clock is ticking. So maybe we can move to the property damages, if you don't mind.
Yeah, absolutely.
So on property damages, this global trend that you know. So what we wanted to share is the fact that it could be interesting for us to have a little bit of perspective from Chubb and from FM Global about their loss ratio target for 2022. We understand that the NatCat will be the main drivers for including for the pricing that the clients are going to face in 2022. So Loic, do you have the opportunity to share some ideas with us on this part?
When we look at the last 5 years, only 2019 has been a year where NatCat losses were, I would say, average. 17, 18, 20, and 21 all exceed about $80 billion of insured losses. And apparently, according to Munich Re, 2021 will be the second costliest year for the insurance industry in terms of NatCat losses. The estimation for the moment are $100 plus billion of losses. So is it climate change? Is it urbanization, globalization? I'm not sure, but what is sure, it's a growing concern, growing challenge for the insurance industry, and to cover NatCat exposure. And when we see what happened in 19 following two very bad years, 17 and 18 NatCat, it was one. It's not the only, but it's one of the trigger that started the hardening of the market.
Yeah. So I'm sure, Loic, that you will on the next slide you will share some good positive, I would say, feedback for the insured. But maybe Frederick, you want to say a word also?
No, I'm afraid I might repeat myself, but or the rest of the panelists. But it is factual that the average cat burden is skyrocketing. You know, and I like the diagram that you showed just a few minutes ago, which is with the steps, because you take the amount, so in frequency and in impact of natural catastrophes, and as you know, this is core business of reinsurers since the 80s, so 4 decades. The increase of that burden is 700%. So basically, it started in the 80s at $10 billion on average every year for 10 years, and now it is at 70. Just to give you an order of magnitude, people say that the pandemics cost the industry something like between 35 and 50 billion. That's what we have in outstanding reserves. So it's really huge, and there's no reason it should stop. And we think, as reinsurers, that the key driver of the property premium to go up, you really come from 3 factors. One is the economic growth. I mean, it's factual. It's the exposure growth. You have more utilities, companies, corporations. The second one is the urbanization rate as well. Not only we grow, but the density of value is bigger. We all go to the same places, basically big cities, and preferably in the south, in Florida or on the East Coast, etc. So the exposure is bigger, and climate change again. And I just want to give you an example which is very unique because it comes from the US. The only company, large corporation that got bankrupted because of climate change is in the US. It was PG&E, you remember? It was a huge utility company. So think about EDF going bankrupt just because they had wildfires, and the company couldn't survive. They had so many claims around them, they were totally busted by all these claims. So they were, bankrupt. And I think it's a good example because it could happen in any other countries now.
And this is also leading to in terms of predictability, again, the concern of the second type of peril also,
yeah.
the train of consequences after one major
yes.
property damages situation. And I think that all of you are focusing on this to have a better data and to
yeah, because modeling is weak on the second peril.
Yeah.
Yeah.
So so the next slide, maybe I will go quickly. Sorry. It's always when you are doing a presentation. It's always like that. Financial lines, so big trends in the US. You know, you are, maybe some of you very familiar with that. So I think that what we've got on the roadmap on the cyber, you know everything on the cyber, so you've got some figures about average of payments, large payments, huge attackware in the US with a significant amount of money that has been paid, including with some of insurers that were targeted. And of course, on the agenda, you've got all the new regulation. And you know, new regulation are always mostly coming from the California states, I would say. So there are big things that are coming that could link to additional pressure on insured and, of course, potential additional litigation. What is on the rise also is in terms of fiduciary pension funds, is the excess fees litigation that is now touching every type of sector because some plaintiff bars have identified some failure and they try to lodge a systematic, I would say, type of litigation. And this is leading to additional level of settlement. And then on the underwriting, we have seen the consequences on the market with a big increase in terms of pricing and wording type of exclusion, all the things that the clients are not happy with. In terms of employment practices liability, but we still don't know if the COVID-19 claims are behind us or in front of us. It was a little bit tackled by David earlier. And I think that, of course, underwriters are focusing on the things that you know, Me Too, Black Lives Matter, and so on. It's not new in terms of employment liability type of litigation. And of course, if companies are well prepared and doing the right things in terms of gender balance and so on, and fighting discrimination, you are supposed to be on the safe side. In terms of D&O type of litigation, a little bit of decrease in terms of filing, and Tina shared some data with us during the preparation of the session. But we know that the ACC, for example, is based on the huge profits that have been done in certain sector of activities. They want to get into the details in 2022 with potential investigation. And there is also the DOJ, as you can see, that started to announce that they are going also to do a specific investigation, and again, a lot of pressure on insured and potential their potential insured. This one is a very important one for this presentation for us, because I think that the insurance industry is really supporting the US business, and we've got a few examples. We were talking about the infrastructure plan, the 1.2 trillion that President Biden succeeded to obtain the vote. And you know that today the insurance industry in the US is currently involved in those supporting the infrastructure concern with more than $566 billion of dollars through corporate and municipal bonds, equities. And the insurance industry is going to continue to support what has been voted. It's clearly mentioned. And what is also interesting to know is, for example, the insurance regulator in the US starting to launch a big survey with customers, people living in the US, about climate changes and how they want to be insured or not, and what are their triggers in terms of insurance coverage to include climate changes. So you can see that also the insurance industry in the US is very proactive to tackle the big transformation that we were talking about. And what we want to share with you today is something that is called the Pandemic Risk Insurance Act, that has been put on the table by the US Treasury, and it was also tackled by the Parliament to anticipate and build solutions to support the economy strongly impacted by pandemic situation, to prepare the next future pandemic situation. So, Tina, I think that you want to highlight what was in fact, what has been prepared, how the market was receptive or not to this proposal, and how Chubb was particularly dealing with this situation and potential opportunity.
Yeah, thank you. So we have about 4 minutes, so we'll make this fast. I'll spend our time talking about PREA. I know all of you have heard about PREA. Essentially, the way the government looked at it and the way the insurance industry actually is looking at it it's really lumped into two different buckets. So you have the fully funded federal government category, and then you have this risk-sharing insurer and federal role. With the fully funded federal government category, that's essentially where the vast majority of the insurance industry falls into. They really don't want to do anything. They want to simply be a conduit to move money for the government into businesses' hands, but there's really not a whole lot of companies raising their hands to do something. And it's a little bit different than PREA. So the second bucket, which again is maybe more interesting, which is the risk-sharing bucket and the risk-sharing arrangement, it's where obviously the industry would take a very small portion of the risk, and they would get compensated for it, and it would be backstopped and working with the federal government. So somewhat similar to TRIA, but not exactly. So as you are aware, PREA was originally introduced by Carolyn Maloney from New York. She has actually put out two different versions of the bill. One was put out in 2020, another one was put out in 2021. Both of them mimic the Terrorism Risk Act that I think all of you are familiar with as well, in terms of the structure around it. Chubb, we also put out our own concept and our own proposal. We took a little bit of a different approach than PREA because we think that the pandemic is slightly different than terrorism, and it deserves that set of eyes and that perspective. So within the Chubb proposal, we ultimately have two different categories. One is specifically for small businesses, and the other is for the mid and large-size companies. We have that simply because we believe that the exposures are different in those companies, as well as how the risk would be handled. That's essentially the proposal in a nutshell. We also have in that other risk sharing side, there is a business coalition. It's essentially the same people that came to the table that did TRIA. That proposal is a third proposal, and it has a lot more coverages and lines included in it. Ours is strictly, the Chubb version is strictly for business interruption. I don't know if you have any questions on it, but. I mean, Congress has seen it. There have been discussions in 2020 about it, discussions in 2021. Right now, it's died down a bit, but I'm sure there will be additional discussions on it.
Yeah, so what I'm suggesting is maybe to have a few questions based on what we have presented. We started a little bit late, so, of course, if you have some question linked to the specific line of business, we can give some perspective also. And there is one thing that we want to tackle maybe before the end of the presentation in terms of trends, the market drivers. So you have the things in the back, but I think that we wanted to tackle a little bit the ALS because Frederick has prepared something on that. So in terms of things that are also on the table, the raising of parametrics, we think that it was key to present a little bit the insurance-linked securities as a potential alternative. So maybe you want to...
Yeah, so it'll be very short because it's a topic in itself. I just want to mention that parametric and alternative capital are still there. There was a reduction of activity in 2020 and early 2021, like the rest of the market. But just for information, Q4 2021 was the second best year in terms of issuance of bonds and ILS in the whole history of that kind of market. That's point number one. Point number two, and I think this is illustrated in the graph, you can see that the issuers, the buyers are in the majority US-based or Bermuda-based. So it really is something that is related to the vibrant market in the US. The third thing, it's also in a diagram, is that most of the perils that are covered in these kind of instruments are, again, US perils. It's California wildfires, flood, earthquake, hurricanes in Texas, et cetera, et cetera. And the fourth one is the list of the buyers. It's sort of a tornado diagram behind me. Same thing, the 21st are in majority US. SCORE appears at the number 13. It was for 2021. Could be different next year. And I think Hanover is within the first 10. But the rest is mostly US-based. Why? And why do we still have about 15% of the overall reinsurance capacity, which is about 60 billion, still with this market? Because, again, it's a very nice decorrelation instrument for the capital markets. And the coupon, the return on the investment is pretty good. I had some figures. The coupon pricing for 50% of these bonds were 2 to 4%, for 30%, 4 to 10%, and for 20%, more than 10%. So when you see what the level of interests are today, I mean, they might be higher along the way, but today, it's kind of a nice return. So except if you have a question, I think there is no real change, except, again, that the U.S. is a very vibrant market, and, you know, because of the exposure, but also because of where the capital is, it's still a dominant piece of the market in the U.S. for the reinsurers and the retrocessioners.
Okay, so maybe you have some questions. It looks like a meeting with insurers as a client. Usually at the end, do you have questions? No. No question, no. A question.
I only have a question on the casualty side, because this year for the renewal 2021-2022, we experienced a huge increase inflation premium. And I mean, on the umbrella and excess side, over auto liability and GL. And I wanted to have your view in respect of the market future, in respect of inflation of premium and capacity also. Thank you.
So on the slide, you can see that the outlook from the financial analyst for the casualty and the main lines of business is an increase by 8 to 10%. It depends, of course, of every company situations and the insurers. I would say it will be every situation will be different from an insurer to another one. But maybe Tina, you want to give a little bit of highlight.
So 2021 on casualty, and I know you mentioned umbrella, excess casualty. There was a lot of restructuring of programs. And I mentioned this earlier, but you know, loss costs are trending high on the liability side, right? But I know that in the United States, if you didn't restructure your program in terms of taking on a higher deductible, a higher retention, perhaps maybe put in a corridor aggregate, stop loss, you know, that was the common practice in 2021. And it varied by risk, it varied by industry, but ultimately just about everyone that went through a casualty renewal saw that. And the umbrella, the umbrella carriers were requiring greater attachment points on the auto liability, on the general liability. So they had to bump up, right, limits on the primary side. Every client has done it a bit differently in terms of either they're stair-stepping this change, or they went from, you know, A to Z overnight in 2021. So I think what you can anticipate for 2022 is, if you haven't already increased your retention or looked at your structure, I think it's the time to be creative, right? Whether that means again, taking more risk on, maybe you have a captive arrangement, but you're gonna, I think, you need to anticipate that same trend coming through in 2022 to a lesser degree, to a much lesser degree. And again, it depends on your program and what you put together in 2021. But I can tell you, just about everyone, every large account had that challenge.
And then the competition between actors will be certainly important, because a lot of people are launching bid of tender on the client side, trying to find a way to create competition in a market with not really a big competition between actors. Frederick?
No, I just wanted to say something, because we did an analysis within SCORE, and David will be very helpful in confirming this, but I remember he used the term nuclear verdicts. And we did an analysis within our portfolio at SCORE as a reinsurance company, and I can tell you that most of the cases were auto liability. So, for example, we had a loss, I remember that one because I was still in the US, where we had a truck accident. It cost $100 million for just a truck accident against a car. I mean, you know, this is massive.
The nuclear verdicts, you mentioned it, we're seeing them in medical and pharmaceutical companies, we're seeing it in transportation, and we're seeing it in, there's a third sector that I can't recall off the top of my head, but those are where we're seeing these large losses, and auto losses is a huge issue, And if you have a large fleet, I would say make sure you're prepared at your renewal to talk about what you have in place, what you're doing digitally. How are you protecting your drivers?
Yeah.
Do you have monitors in the
Telematics,
car?
yeah.
Do you have training? Do you have safety? They're looking. All the underwriters are looking to see that.
Thank you. Other question?
About energy transition, you mentioned it's a key issue for the United States in terms of roadmap, strategy, etc. when talking about decarbonation. My question is, with regard to climate, natural disaster, etc., which role, what is the solution for energy industries when facing huge impacts on their infrastructure? What happened in Texas when there was a global blackout in terms of power, impacts of hail on solar panel, the freeze of wind farms, and in better cases, we just face kind of burden of primes when sometimes it's complete withdrawal of insurers. So what is the solution? What about coverage and in the same time going forward this strategy in terms of decarbonation when there is no solution and no support from insurance to cover infrastructures, renewable ones, in case of catastrophe, climate, and so on. Thank you.
Thank you for the question. So I think that, this is something that we are dealing with as a leader in the pharma biotech industry. There are some risks and difficult to attract some carriers in terms of risk transfer, and this is why we decided to use our own, to have our own direct writing insurance company and be able to be a risk taker, be in the same type of family with insurers and reinsurers, and find a way to do risk financing, and through the risk financing trying to attract insurance actor to find a risk transfer. So maybe the opportunity for you is really to think about alternative risk financing, what you can build. Of course, there is a business plan, and the finance guy need to be involved, and it's a global concern for a company. So you will always find some budget if you've got a clear idea of what you want to achieve. And I think that you need to, there are some big players certainly also in the room able to help to build this kind of solution, but you need to certainly to find a way to deal with kind of alternative risk transfer, and then trying to attract some actor from the market to find a little bit of risk transfer, and then you will be more independent, and through the insurance, the self-insurance that you are going to build, you will be able also to collect data and to really build something that could create interaction with your own internal stakeholders. I don't know. Frederick,
yeah, well, I think your question, part of your question was a comment or a statement about, I think, was the core of a discussion. On your question on the second part, I think we have solutions, right? It's just a matter of price and capacity, but I don't think the insurance industry and even the reinsurance industry really dropped the insurance of that kind of events, because this is what we do and we've done and we'll probably do in the future. What Cyril said is exactly right. We have to think about innovative solutions where maybe there's more partnership, because when it comes to systemic risk or really high impact type of risk, maybe it's probably better to have more engineered or structured programs where captives or alternative solutions or structured solutions, doesn't necessarily have to be through a captive, play a part, so mutualization happens within the community of insureds, but also within your own balance sheet. So it's a tricky problem. I think we have the tools, we have the money, as we said, the capital is there. It's just a matter of how you attract the capital down to this risk so that it could be modeled in a way, because reinsurers are not very smart. They really rely on calculation and database, and I'm sure we'll find a solution. But it's a tough one. I mean, this is the reason we're here talking about this.
Another question, and we will end up the session. So I want to thank a big thank you to everyone, Loïc, of course, and David. In the middle of the night. So thank you both for the interaction with us. Thank you for Tina to have made the trip to France to bring support this morning. Thank you. Safely, yeah. And thank you too for the interaction with us. So I think that I must say that you need to take a look of the potential evaluation of the workshop. So don't forget it. And we thank you, and we hope to see you again next year with a better condition, I would say, for all of us.
Yes.
Thank you.
Thank you.
Thank you.
Thank you.
Merci.